Investor ready in 90 days. What it actually takes to clean up your financial house. I've watched founders lose points on valuation for a question they could have answered in 30 seconds, if only they had written the answer down a year earlier. An investor asks why Q2 margins dropped last year. You know the answer. One client, specific situation, resolved. But it's nowhere in your reporting. So now you're narrating it orally in real time while they're taking notes. Moments like this usually don't cost you the deal, it costs you the terms of the deal. Most founders I've worked with think investor ready means clean books. Clean books are only the foundation, they are the table stakes. What a real investor is actually checking simultaneously is four things. Are the historical numbers reliable? What those numbers actually represent? Whether the financial model is credible, and whether the process that produced all of it is robust. That one last one is where 2 to $10 million businesses fall apart. Not because the books are wrong, but because nobody can explain how they were produced. 90 days is enough to fix most of what's broken, but only if work starts before the fundraise is live, not after it. Here is how I would structure it. First month is diagnostic. Pull the general ledger for the last 2 or 3 years. Read it the way an outsider would. You'll find things. Revenue classified one way in January, another way in August. Expenses sitting in OPEX that should have been capitalized. Receivables from 2 years ago. Nobody's collecting. None of this is a crisis. But if an investor finds out before you do, it could become one. Second month, you build the story the numbers tell. A three statement model, 24 to 36 months of history presented consistently. A management reporting package that explains the business, not just tracks it. This part matters more than the model itself because an investor who understands why a number moved gets comfortable. An investor who has to guess does not. Third month is the forward model and the data room. Base case, upside, downside. Not three different versions of the model, but actual scenarios with the assumptions very clearly visible. And the data room gets organized the way a typical IRL shall read, not the way your Dropbox or say Google Drive is structured. Here is what most founders miss. The businesses that close fastest are not the ones who sprint for 90 days. They are the ones whose diligence becomes a confirmation exercise because the work was already done. You don't clean up your financial house for the race. You clean it up so that when the race happens, you're not a bottleneck.